And in the studios today, we have Ted Topouzis with Topouzis Associates. And Ted is talking about a very great topic that you should get familiar with if you are not. And if you already are familiar, you might learn a thing or two from Ted with over 20 years of experience in the business as a real estate attorney. We're talking about the 1031 exchange, right,
That's
Ted?
right, Emilio. Yep, that's right. I hope you learned something from this. I wanted to start the segment up with just a statement saying that I'm not a CPA or a tax professional. I'm a real estate attorney, but in serving as a real estate attorney, I've had decades of experience with transactions involving a 1031 exchange. Mm-hmm. And so I wanted to give a segment on what this is all about and how it can help serve your needs when you're selling a piece of property. Okay, so essentially, what a 1031 exchange is it's a segment of the code, the Internal Revenue Code, that provides a tax break to an owner and a seller of an investment business, real estate, mm-hmm. From potential capital gains that would result from the sale of such an asset. And it's essentially an investment property. Just let me explain a little further. Is something that is held for a gain or appreciation. Mm-hmm. So by setting up a 1031 exchange, you're essentially creating a shelter that would allow for the proceeds that you would allocate for the payment of a capital gains towards buying power, purchasing power for your new asset. Because a 1031 exchange is exactly that. It's an exchange. You're selling a piece of property, but you're required by the terms of the code to purchase a new property.
And that's really great. And it's within, what's the terms, a year?
It's the way it works is you have 45 days. It's a good point. Oh. You have 45 days from the sale of the assets to identify a new property, and then you've got you're familiar with it, 180 days from the sale to reacquire a new property, a replacement property.
Okay. Yep. So you have to have a property in pending within 45 days. That's what you mean by identify the new property.
That's right. Yeah, you do need to have it in pending, and so time is of the essence when you're setting up a transaction such as this, because you really need to go into it knowing that you've got time frames, time constraints, and that you need to have a set of professionals handy, that are able to give you a little guidance through the process.
Sure.
You can't think of this on the fly or once you've already really entered into a contract. It might be too late at that point.
I've got several clients that not only buy residential property, but they buy commercial properties. And by the way, commercial properties can be in the form of multifamilies with 4+ units, okay? They can also be in the form of office buildings, warehouses, et cetera, et cetera. So you can roll all of that over in the 1031 exchange. Real estate is real estate, right?
That's right. It's, as long as it's for this part of the code, as long as it's a business or an investment property, you can use that and liquidate, use those funds. As long as you don't get access as the seller, you get access, immediate access as a seller to those proceeds. You can use those funds towards the purchase of a new property, dollar for dollar. This 1031 exchange should not be confused with Section 121 of the Internal Revenue Code, which applies to the sale of a principal residence. So, an individual gets a $250,000 tax break, and a married couple would get up to $500,000 of a tax break, which would be protected proceeds from the equity of their home, their sale. So, I wanted to quickly just touch on a couple benefits of such a 1031 exchange. Again, it's a tax break from capital gains that you would realize from the sale of an investment property, and it applies to both state and federal taxes. So what you would do here, what the normal situation would be to sell let's say, an underperforming asset. Raw land would be an example, and you want to upgrade to something that has maybe some cash flow, like a rental property. You could use this mechanism for that. You're selling one property in exchange for another. That's perfectly fine. The again, the purpose of this is that you have the intent when you're going into the purchase of the replacement property that this is for gain or appreciation. That's the key.
I've got a question that I think a lot of our listeners may be asking.
Sure.
Now, let's just say if you sell a property for $200,000 and you roll the money over into a new property for $150,000, you're still going to get taxed on that $50K excess, or you would have to maybe find a property.
You're exactly right,
or
Emilio. That's 100% right.
Yeah, okay.
What would happen is if you purchase a property for less of a value than the initial, then you would either get exposed to a capital gains on the difference, or you'd have to purchase another property to make up that difference. So you go from one to perhaps multiple properties.
Sure, okay.
So the primary benefit of this really is just, if you can picture it, is that instead of paying the capital gains on the sale of this property, you are able dollar for dollar to use that capital gain money towards acquiring property,
building your portfolio.
Yep. That's right. So I'll give you a quick example here. We've got person X and person Y. Person X doesn't do the exchange. Person Y does. Okay, we've got properties of equal value that are being sold, $250,000 apiece. Both parties have an initial investment into the property of $100,000, so they stand to gain $150,000 apiece. But they're required to purchase, or they're going to, in my hypothetical, purchase a property of $250,000 in value. But again, X didn't do the exchange, Y did. So X would have a tax on the $150,000 gain that's at 20%, which would be $30,000. Where Y could use that $30K and roll it into the purchase of their new property. So you can see the benefit of it. This is
huge.
simple math. It's
big money.
Yeah. So some things that keep in mind here is that we've got to think ahead. Okay, you can't just on the fly decide, hey, I'm going to do this. You've got to get some players involved. Once you've taken possession of these sale proceeds, it's too late. You're going to get taxed on those proceeds and on a capital gain. So you need to act fast, and you really need to act prior to putting your property on the market. So you need a couple players involved. You need a CPA. You need to consult with them to make sure that this is the right situation for your needs. There has to be what's called a qualified intermediary setup, which is a kind of a middleman. That's the party that would prepare the documents, put them all together for you, consult with the closing attorney, with the real estate agent, to make sure that the monies are being put into this account on the sale of the asset, and then used for the subsequent purchase of a new asset without any of these proceeds being conveyed to you. You could potentially take some of the proceeds on a sale, but you would get taxed on those proceeds if you were to get paid out some proceeds at that closing. So there's no limitation on the number of times you can use the 1031 exchange. So you could use it a number of times, and just to keep in mind, you can actually roll if you're looking down the road to retirement, you can actually roll the proceeds from this investment property into a retirement home that you would eventually take possession of. But the key is, at the time of acquisition, you have the intent to rent that property out for at least a minimum of 2 years, and then you can, if you decide not to rent it out anymore, you don't renew that lease. You move into that property and use all those proceeds to the purchase of that retirement home at no taxable consequence. So it's really a pretty cool thing to take advantage of, and I think it's underutilized. I just wanted to emphasize the fact that you do want to reach out to a CPA and to get to make sure that this is the right fit for your tax needs. And because you've got to get some players into the process early on before the property's potentially put on the market because time is of the essence, and you don't want to miss out on getting that tax shelter, the benefit of that tax shelter.
Sure.
You need to set up a qualified intermediary, and this is that middleman that's supposed to get the proceeds of the sale of that property. And of course, you need a knowledgeable real estate agent like Emilio and his team to set you up on the sale of that asset, getting the right value for it, and then immediately looking for a replacement property. You definitely need to do that because, again, you've got 45 days from the sale of that property and 180 days from the sale to actually finalize the purchase of a new one. You need to identify a replacement property in that 45 days and 180 days to actually close on it. So time is of the essence.
A lot of moving parts, too.
Yeah, a lot of moving parts. And of course, you need an experienced closing attorney like myself.
Yeah, exactly.
That would be nice
Exactly.
to make sure that you've got somebody watching your back and communicating with the parties involved. So yeah, it's a great tool, and it's well worth your while to consider it.
Sure. Ted Topouzis, 401-533-9888. And again, I would strongly recommend talking with Ted, and he can link you up with all of the right people. And you know, if it's outside of Rhode Island, you're looking into Massachusetts or whatnot, we've got agents out there. I mean, top agents out there that can really help you out anywhere in the country. We've got a huge network of attorneys and agents.
I wanted to mention too, I'm licensed in Massachusetts and in Florida as well. So in case
in addition to
the
Rhode
audience
Island,
that's right. In addition to Rhode Island, in case the audience has any questions in those states.
Your office is in Miami?
I have an office in Miami and another one here, of course, in Rhode Island. So we
Jefferson Boulevard in Warwick.
We cover all three states.
That's awesome.
Yeah.